So, I'll talk to a lender and I'll say, what's your quote today? And he'll say, well, I'm quoting 7%, 1 plus 1 is the way that the lender will put that. And I know what that means, and you should know what that means too. The first one is the origination fee. Typically, it runs 1%, but it depends on the type of the loan, it depends on the lender. The origination fee is the major fee that the lender charges for making that loan, and it's going to be 1% of the loan amount. If you're working with a loan officer, a lot of times they'll get 50 or 60% of that origination fee as their commission for placing the loan. The second number is called a point, or more specifically, a discount point. Now, a discount point, and I think the slide talks about it here, it increases the lender's yield on his loan by 1/8%. It's also equivalent to 1% of the loan amount. Okay? So let's see how that works. If we had a $100,000 loan and we charged 1 point on that, it would be 1% of that, or you can do that math in your head. That would be $1,000. Okay? Now, you may wonder, where does that $1,000 go, and why do we call it a discount point? Well, it works like this. I can erase this. In the secondary market, you've got the Federal National Mortgage Association, Fannie Mae. In our primary market, we'll put a mortgage banker down here. And we're still working with that same $100,000 loan. So we write a contract on that property, and we say maybe we ask the seller to pay that 1 discount point. So we close on that transaction. The borrower gets a $100,000 loan, and he's going to get that. Remember, we said that was at 7% interest. He's going to get a $100,000 loan at 7% interest, and the lender's going to get $1,000, that point that we talked about just a moment ago. Okay? Now, when the mortgage banker sells this loan into the secondary market, that's where those discount points come into play. Because we'll say, for example, Fannie Mae today is going to buy loans that yield her 7 1/8%. And she'll have a quote on a daily or monthly basis of the yield that she needs to have in her portfolio before she'll consider buying the loans. So we've got a loan to sell her, a $100,000 loan, but guess what? It's only at 7%. And Fannie Mae says, I'm not going to buy it unless it's at 7 1/8%. So the banker's got a problem. So what does he do? He's got $1,000 extra here out of this transaction. So he sells that loan to Fannie Mae. Fannie Mae gets a $100,000 loan that has a note rate on it of 7%. But how much does she pay for that? She pays for that loan $99,000. She discounts it by 1% because in the lending industry, 1 point is roughly equivalent to 1/8% yield increase for the lender. 1/8 to a 1/4 depends on the lender that you're talking to, but that's a rule of thumb. You can't figure that mathematically, by the way. It's based on how soon Fannie Mae thinks that loan will be paid off. If you try to do it mathematically, it doesn't calculate. It's just an industry standard. So that 1 point is equivalent, will raise the lender's yield by 1/8%. So what happens here, and I'll reiterate, is we've got a $100,000 mortgage. We sell it to Fannie Mae at 7%. Fannie Mae needs a yield of 7 1/8% for her to buy the loan. So she buys the loan, but she discounts it by $1,000 to $99,000. Now, is the lender okay? Yeah, because he got $1,000 at the closing plus he got $99,000 here. So the lender is whole, and Fannie Mae is happy because she's got a $100,000 loan at 7% that she only paid $99,000 for. That's why we call it a discount point, because it discounts from the 100 down to the 99. It has to do with the interaction of the primary market and the secondary market. Okay, let's go on from there. Now, talking about lenders in the primary market, we can talk about first about commercial banks. And as the slide says there, they're an all-purpose lender. If they're involved in home loans at all, it's usually on a short-term basis. And you'll say, well, Tom, though, I went down to Bank of America and got a mortgage. Well, that could very well be true, but you got it from their mortgage department, not from their commercial banking department. And they've got both departments there, and both of them, of course, work well with each other. Thrifts, savings and loans, a large resource for residential mortgage credit. We also have savings banks and mutual savings banks. Depends on which part of the country you're in, whether you're going to see savings banks and mutual savings banks. They tend to be real popular on the East Coast. I know my part of the country, we've just seen some mutual savings banks start to form there. But of course, savings and loans are across the entire United States. Credit unions have become a fairly good source for loans. And I always ask my borrowers, do you belong to a credit union? Because one of the things that credit unions will do is they will usually discount that origination fee that we just talked about. Normally it's 50%, or I should say 0.5%, instead of that 1%. It's half of that 1%, which is a normal, a typical fee. Insurance companies, you're not going to see in the residential market. They want to make the great big loans in the commercial markets. Private individuals, call up grandpa and get a second loan for a down payment. That's why he's a major source of junior loans. You need to know the difference between mortgage bankers and mortgage brokers, okay? Mortgage bankers originate, fund, and warehouse and service their own loans, whereas mortgage brokers originate loans for other lenders. Mortgage bankers will make loans out of their own pockets. Mortgage brokers are like you and I, except that they broker money. We broker real estate. They broker money. They'll take the money and put the money and the borrower, or excuse me, put the lender and the money and the borrower together. That's what a mortgage broker does. The mortgage banker performs basically the same function, but he's got his own money that he's going to loan, and then he's going to take payments back. Market is at the top of the page, and the primary market is at the bottom of the page. And remember, we said the primary market is where loans are originated, serviced, warehoused, and the secondary market is where loans are bought and sold. And with that in mind, let's walk through this, and I'll see if I can help you put this whole thing together in your head in a reasonable fashion. And we're going to start with the National Housing Act in 1934. Before 1934, our housing market was kind of in a disarray across the United States. If you wanted to buy a house in the United States, the most common financing plan was 100% down. If you didn't have 100%, you may have got one bought for 60% down, or maybe 40% down if you had a really small down payment. And then you would have an interest-only loan for 4 or 5 years, and you would have to refinance the note at the end of that time. That was the kind of a housing market that existed through the 19-teens and the 1920s in the United States. And what happened in the 1920s is, of course, if you remember your history, the stock market was going up on a daily basis. The stock market was going nuts. And so it was sucking the money out of the housing market. And when your farmer or your homeowner would go into his local bank in Midwest United States, and he would say, I need to refinance my note. And remember, he's been paying interest only and a little bit on the principal for the last 3 or 4 years. He's never been late on his payments, okay? He's been current all the time. And he goes in and he wants to refinance that note. And the banker says to him, Tom, I'm sorry, I can't refinance the note. My investor wants his money. What's the investor going to do with the money now? He's going to put it on Wall Street. He's going to buy stocks and bonds. We can't refinance your property. And I said, well, I have no other way to pay for it. He says, well, that's too bad. We're going to have to foreclose your property. And so we saw foreclosure rates going up in the 1920s because of the financing market. President Roosevelt was elected in 1932, took office in 1933. He hired a brain trust out of the universities across the land, and he said, we need to fix this housing market. And they came up with the idea of federal housing insurance. They actually came up with the idea of the Federal Housing Administration, the FHA. So, in 1934, Congress passed the National Housing Act, which created the FHA, and that's really the start of our modern financing economy today, or the way it works right now. So we'll start with 1934 and build from there. Now, the FHA was very popular. Mortgage bankers were making FHA loans like crazy. And of course, they ran out of money pretty quick. You know, if I have $20 and I loan it to you, and then I say, well, you can make payments on it at $1 a year for the next 20 years, it's not going to be very long before I'm out of money, and I'm going to have to wait a long time to get my money back. That's what happened to the mortgage bankers in the 1930s. But Congress, in its wisdom, had foreseen that this could be a problem, and so what Congress did was, in 1938, they created Fannie Mae. And Fannie Mae was created for the express purpose of purchasing those FHA loans. In other words, Fannie Mae created liquidity in the marketplace where no liquidity had existed before. So now these mortgage bankers could sell their loans to Fannie Mae, they could get money back, and they could turn around and loan more money. FHA became very popular. In addition, FHA came up with another couple of good ideas. They came up with the idea of an amortized loan, equal payments over a long period of time. They also reduced their down payments from 60 and 40% down to 20%. Now that sounds like a lot today, but back then that was a good deal. And so FHA loans became very popular. Now if we move up the line chronologically,